All right, let's just jump right into it. The past few days in the markets have been, well, an absolute roller coaster. We've seen these insane whiplash moves, headlines that totally contradict each other, and just this general feeling of what is going on? But what if I told you none of this was random? What if this is all part of a predictable and, for some, very profitable pattern? We're going to break down this wild theory that suggests the markets are being played by a very simple, repeatable cycle. This quote from a market analyst just says it all. It basically means there are no words for what just happened. And honestly, when you see the timeline of events, you'll get it. It was the kind of market-moving drama that has left even the most seasoned pros just shaking their heads, completely fed up. So let's set the scene. We're talking about a period of just extreme volatility. And it was all being driven by these geopolitical headlines that seemed to change by the hour. It was one of those times where it was pretty much impossible to figure out what was real and what was just noise.
Okay, just look at this timeline. It's nuts. First, you get what looks like a threat of war. Trump gives Iran a 48-hour ultimatum, and the markets, they freak out. Futures tank, bond yields shoot up. Then, a single tweet flips the entire script, a 5-day pause for productive conversations. And boom, just like that, the markets reverse. The S&P 500 is up 2%, Bitcoin and Ethereum rocket up over 5% in minutes. But then, here's the twist. Iran comes out and denies everything. They say it's a lie and call it psychological warfare.
And this is where it gets really crazy. You've got two completely opposite stories from the people at the center of it all. The White House is saying, yep, we're having productive talks. And at the same time, Tehran is saying, that's a flat-out lie. We haven't had any communication at all. So who are you supposed to believe? The market was just left swinging in the breeze, reacting like crazy to every new headline. And to give you a sense of just how big these moves were, look at this number. In a single day, between the ultimatum and that calming tweet, the gold market lost and then instantly regained $3.1 trillion in value. I mean, think about that. More money moved because of one tweet than many countries make in an entire year. This isn't just a ripple in the pond, it's a tidal wave. So you really have to ask yourself, was this all just chaos or was it choreographed? Well, according to some analysts, this wasn't random at all. In fact, it fits perfectly into a deliberate 4-phase cycle of market manipulation. Let's break down what that looks like. Now, here's the interesting part. This isn't just a theory pulled out of thin air. There's what some are calling a blueprint for the chaos. This infographic lays out a repeatable pattern that seems to explain not just what just happened, but a bunch of other incidents over the last couple of years. It suggests there's a real method to all this madness. So let's walk through the 4 phases. It all starts with phase 1. You create some pressure. You introduce a threat, maybe new tariffs, or like we just saw, a military ultimatum. This creates fear. And that fear leads right into phase 2, the 5% limit. All this worry about inflation makes investors sell off their long-term bonds, and that pushes the 30-year bond yield up towards this critical 5% red line. As soon as it hits that line, it triggers phase 3, the calming statement. A tweet, a public comment, something to de-escalate everything. And that, of course, leads to phase 4, the market resets. Bond yields fall, stocks bounce back, and the whole cycle is complete, ready to start all over again. Now, let's zoom in on that trigger, because this whole theory really hinges on this idea of a 5% red line for the 30-year U.S. Treasury bond. So why is that number so important? Well, because it's a huge pain point for the economy. When long-term borrowing costs get that high, everything gets more expensive, from mortgages for families to the interest the government has to pay on its own massive debt. It's the point where financial pain becomes a political problem that somebody has to fix and fast. And this isn't just a one-off thing. Look at this pattern here. Back in April 2025, universal tariffs push the bond yield to 5%, and what happens? Trump immediately promises tax cuts. Fast forward to February 2026, new tariffs do it again, and he tweets about incredible deals on the way. And then just now, with Iran, we hit 5%, and we get a pause for dialogue. The point is, every single time the market hits this pain threshold, some kind of intervention magically appears. Now, while all this geopolitical drama was sending shockwaves through the stock market, something huge, truly industry-shaping, was quietly happening in the world of crypto. So let's pivot for a second and look at the new foundation that's being laid for digital assets. Okay, so the massive news is this. 16 major cryptocurrencies, including the big ones like Bitcoin, Ethereum, Solana, and XRP, have now been officially classified as commodities. For years, these things have been stuck in this regulatory gray area, always with the threat of being labeled a security, which would bring on a ton of stricter rules. This is a total game changer.
So why does this matter so much? Well, as commodities, these assets are now regulated by the CFTC, which is widely seen as being way more flexible and friendly to innovation than the SEC. This brings so much clarity. It lowers the legal risk for exchanges, it clarifies the rules around staking, and maybe most importantly, it clears a massive hurdle for new ETFs. I mean, just think about it. This could open the floodgates for a Solana ETF, an XRP ETF, you name it. All right, so beyond that huge ruling, the crypto market is still this wild mix of high-risk warnings on one hand and signs of long-term strength on the other. So let's do a quick pulse check on the key things you need to know about right now. First up, a serious word of caution. You might have seen this token called Siren posting these incredible gains, but you have got to be extremely careful. Our sources show that a staggering 88% of its entire supply is held by just a handful of wallets. That means a tiny group of insiders could crash the price to zero in an instant if they decide to sell. This is a classic, textbook red flag for a potential pump and dump. Next, we're seeing what looks like a real crisis brewing in Bitcoin mining. This chart lays it out pretty clearly. The average cost to mine one Bitcoin right now is about $88,000. The problem? The price is hovering around $71,000. That means your average miner is losing money on every coin they produce. Now, historically, when miners are forced to give up like this, it can signal a market bottom, but it also means a lot more selling pressure in the short term. But here's the flip side to all that fear. While smaller investors might be panicking, the big institutions are quietly buying. MicroStrategy just scooped up another 1,000 Bitcoin. Over in Europe, H1 Group is getting ready to manage over 3,500 BTC. And in Asia, Boya Interactive is planning to add another $70 million to its crypto stash. They are clearly playing the long game here. Which brings us right back to where we started. We've seen a chaotic market that seems to dance to the tune of a few announcements. We've seen a crypto world that's finally getting some clarity. But at the end of the day, when a single tweet can move literally trillions of dollars, it leaves you with one final and pretty important question. In a market that seems to be directed by tweets, who is really writing the script?